Welcome to Talk ETFs, ETF.com's weekly video series. I'm Sumit Roy, and I'm Senior Analyst for ETF.com. This week's guest is Fran Rodilosso. He's the head of fixed income ETF portfolio management for VanEck. Fran, welcome to the show.
Thanks for having me on.
Fran, anyone that was around during the global financial crisis in 2008 remembers the alphabet soup of investment products that got banks into a lot of trouble. Things like CDOs, CMOs, etc. And they had a pretty bad reputation back then, but 15 years later, that doesn't seem to be the case any longer. These type of structured products are back in vogue, and there are even ETFs which hold them, which we'll talk about in a second. But before we do, can you tell us about collateralized loan obligations, or CLOs? What are they and how do they work?
Absolutely. And maybe before I talk about what they are, I will say they are a form of CDO, or collateralized debt obligation, and they have been around for over 30 years, including during that period of the global financial crisis, 2008 and 9. These were not the structures that typically, quote unquote, blew up or caused major problems on bank or fund balance sheets. Although they did suffer price losses due to volatility. The permanent losses due to default on CLOs versus other types of CDO during that period were extremely, extremely small. Even in absolute terms, they're extremely small. But CLOs, or collateralized loan obligations, are basically they're portfolios of senior bank loans, or what the world knows as levered loans, that are actually actively managed. So that would be the asset side of a CLO. In order to fund itself, a CLO issues various tranches of debt, various levels of seniority, and a small amount of equity as well. And so the equity piece takes first loss should there be non-performance of some of the loans underlying a CLO. And then there are various tranches of debt in the mezzanine, lower investment grade rated, all the way up to AAA.
That's great. So like you said, bank loans make up the asset side of CLOs, which raises the natural question, Fran, what is the advantage of investing in CLOs versus investing in bank loans directly? Is it the ability to buy these higher rated tranches, thus reducing the likelihood of potential losses?
There's all sorts of optionality around CLOs, because you could buy, you could invest in equity or mezzanine tranches. In the context of the ETF we launched, we think the advantage is, yes, you're getting access to that senior bank loan market, but a CLO typically holds hundreds of loans. There are all sorts of diversification rules, so you're getting broad diversified exposure, but also, yes, you're getting credit enhancement. So there have actually, over the history of CLOs, no AAA tranche has ever actually defaulted. Whereas only, I believe one AA tranche and only a handful of single A tranches have ever defaulted. So you're getting an attractive yield pickup over other forms of investment grade debt, and by indirectly owning or accessing levered loans. But it's really the credit enhancement and the built-in diversification that make these attractive vehicles.
So a little over a year ago, Fran, you and VanEck launched the VanEck CLO ETF, ticker symbol CLOI. Can you tell us about this ETF?
We launched CLOI to have the ability to invest broadly in the investment grade CLO tranche space, and with actually a small sleeve to be able to invest in double Bs as well, on a very opportunistic basis. When we researched how to approach the CLO market, and we spent a couple of years looking at this, we came to the conclusion that this is best managed actually actively, that there are many nuances and ability to add alpha, not just through macro calls, but through understanding structures and managers in the CLO space. As I mentioned, these are actively managed vehicles themselves. So we partnered with PineBridge Investments, who's got a very, very large CLO business themselves, both as an issuer and as a manager of CLO tranches. PineBridge in their funds and in CLOI will not buy CLOs, by the way, issued by PineBridge. So the idea is to leverage off their experience and knowledge of the universe to invest broadly in the investment grade space in CLOs.
So, what type of characteristics does a fund like CLOI have in terms of yield, in terms of credit risk, and in terms of interest rate sensitivity?
CLOI has the ability to shift within the investment grade CLO space. Now, over 60% of the CLO market is actually in the AAA rated securities, but that still means there's a lot of subordination, and that's why the AAAs have been quite safe. So during other periods, you may see a fund like CLOI invest maybe 30, 40% in triple Bs or triple Bs and single As. Presently, the fund is well over 90% in the AAA and AA tranches. So very high up what CLO managers call the cap stack, but very high in the rating spectrum. Mostly, the majority of that is actually over 84% is in AAA tranches. But still the yield on the portfolio sort of yield to worst as of the end of June, and those weightings were as at the end of June was over 6.6%. So versus other exposures, especially at the high end of the investment grade credit universe, it's a fairly high yield. It's also, these are all floating rate instruments, CLO tranches, so there's no interest rate duration, or virtually no interest rate duration. Coupons reset typically on a quarterly basis. So very low interest rate sensitivity. Obviously, credit spread sensitivity, though. So as spreads in the CLO universe move, that's where you could get some price volatility.
Fran, how would an ETF like this fit into an investor's fixed income portfolio?
Several ways. We've seen investors use CLOs as an alternative to other types of investment grade credit. So, a way of reducing their duration and enhancing yield within a broader investment grade allocation. As investors, like the idea of higher yields and may want still to have some exposure to the higher yield or sub investment grade universe. CLOs are a way of going up in quality through the over collateralization of the higher rated tranches and that credit enhancement. Instead of investing directly in levered loans, CLOs, because of the credit enhancement, of course, you give a yield give up by going from a pure levered loan portfolio into AA or AAA CLO tranches. But over the long term, they've actually delivered a better Sharpe ratio, so better risk adjusted returns versus levered loans. So we've seen it as a substitute for both high yield exposure and investment grade exposure. Not that although the floating rate nature is a feature, it's really the attractiveness, the risk adjusted returns, the attractiveness of the yields that make CLOs, we think, most compelling.
Because they are floating rate products, does it make more sense to buy these when interest rates are rising, or do they still have appeal in this kind of more stable interest rate environment?
We get that question a lot as the market is, a lot of investors have perceived that we're toward the end of the tightening cycle. I mean, some had thought we were past it, and maybe not, but no, in fact, as I was saying, there's a real yield pickup. If you look at AAA CLO, yields, they're pretty comparable to, say, triple B rated corporate bonds right now. So, and if you look at triple B rated CLOs, they're yielding significantly more than high yield corporate bonds. So it's really an absolute yield story. As I said, there will be volatility, price volatility based on spread movements in the credit space, particularly in the loan space. So that has proven to be over time more of the risk, but that's where the opportunity is. The best time to add CLOs is when you have a favorable view on credit. What's really interesting about this universe, though, is sometimes there are nuances that you might not, be aware of unless you were heavily involved in the space, and that's why we were really happy to partner with PineBridge. So there can be there's a life cycle of a CLO, and there may be opportunities when you understand that the equity holders or the sponsors may call the CLOs. You may get these pull to par opportunities when things like that happen. So there can be all types of environments when it's attractive to add CLOs to a portfolio.
Before I let you go, Fran, one risk that a lot of people talk about, of course, is given that these are bank loans and banks are exposed to commercial real estate pretty heavily, is there any connection there between the CLO market and commercial real estate?
These are, broadly syndicated bank loans, so there's no direct sort of, real estate lending per se. There is a very, very small amount actually of REIT exposure in terms of the loans that fall into most CLO portfolios, but it's actually a relatively small weight. In fact, no sector really tends to exceed low double digits. There are all sorts of diversification rules within CLOs, but regardless, REITs are in the lower single digits. So, long story short, there at this point in time, very low, especially direct commercial real estate exposure in the CLO universe.
Well, awesome. We're going to have to leave it there. Fran, it's been an absolute pleasure. Thanks so much for your time.
Thank you, Sumit. Really enjoyed speaking with you.